Let's keep that in mind as we talk about what's happening in the markets today, where we want to be tactically allocating our assets today, and how we think about the bond market and the stock market. So taking a quick snapshot, where are we? Today, the stock market is essentially at an all-time high, and with that volatility, that is to say, the fluctuations in the market have been quite low. Trading has been pretty orderly. Valuations are reasonable. Yes, it's a high-priced market, but it's not an expensive market. I'll talk more about that later. And at the same time, the bond market has been surprisingly volatile. Last year, long-term bonds were really hurt pretty badly when the Fed decided that it would start reducing its purchases of long-term assets. That really hurt interest rates as they went from about 2.5% to 3.5% for long-term bonds. Meanwhile, this year, they've recovered somewhat as interest rates have begun to drop again. At the same time, the more alternative assets, as they're often called, like hedge funds and private equity and venture capital, generally speaking, have not done well, and I don't expect that that's going to change. So what's really happening? Well, if you look at the stock market versus the bond market, typically speaking, they each produce a form of yield or current income. In the stock market, that's dividends, and I show you that on the blue line on this chart. And in the bond market, that's the interest rate on the coupon that you receive every 6 months, and I show that in the red line. Typically, a bond will have a higher yield than a stock will, for the simple reason that the best you can do on the price side of a bond is get back to maturity. That is to say, at the maturity of a bond, you're simply going to get the money back that you put in. Whereas for a stock, the upside is unlimited. The stock price can grow as high as the earnings of the company will permit. What's interesting is that today, with the stock market at about 1,950 on the S&P 500, the dividend yield on the stock market is just under 2%, and the interest yield on a 10-year Treasury is about 2.5%. This is the first time, pretty much since the 1950s, that we've seen these two numbers so close together. Typically, there's much more of a spread in the form of interest rates being higher than dividend rates. So that suggests, if nothing else, that stocks are probably still fairly attractive relative to bonds. Let's take a deeper dive into the bond market. What I'm showing you here on the left side is the Treasury yield, a 10-year Treasury note interest yield going back through the history of the United States. And you'll notice that on the left side, the far left reading is 1790, practically to the beginning of the Republic. What you can see is that by the right edge of this chart, interest rates had hit an all-time low. And in fact, in August of 2012, they hit 1.38% for a 10-year Treasury, the lowest in American history. And since then, they recovered. As you see on the right chart, which goes back about a year and a half, interest rates recovered through most of last year, briefly topping 3%, and now they're just a little bit over 2.5%. The folks at Goldman Sachs did an interesting study, by the way. They looked at this and they took it back even further, going through other countries and trying to make linkages that go all the way back to the year 1285 in Venice, Italy. And they found that in all that period, they had never seen interest rates as low as they were a couple of years ago. So in other words, interest rates today are at a 700-year low. And because interest rates and bond prices work inversely, bond prices are at a 700-year high. So that tells you that bonds in absolute terms are probably pretty expensive. When you have yields that low, investors try to do lots of things to figure out where they can get any kind of interest rate or interest yield to be able to supplement their incomes. Some of these things are smart, and some of them, to borrow a term from David Letterman, are stupid tricks. So let's talk a bit about stupid bond tricks and smart tricks. You'll see here I've listed a bunch of different risks that are associated with bonds. Credit risk is the risk that you might be downgraded or default, i.e. not get your money back. Duration risk is a risk that's really related to price. As interest rates change, what kind of impact does that have on the price of your bond? And there are several others there as well. And again, you can quantify all of these, and we spend a lot of time doing so. Looking only at credit risk first, let's talk about whether there's a risk of default. On the left side here, what you're looking at is the investment grade universe from AAA to BAA, which is also called BAA. And on the right side is the speculative or high yield universe, also known as junk bonds. And over a 10-year period, you can see that the risk of a failure or a default in the investment grade universe is almost non-existent. And that's also true even for the best of the speculative grade securities. You can see that junk bonds, especially municipals, if they're in the BA range, really don't have much of a 10-year default risk. But as you get lower and lower quality down into the C range, all of a sudden the risk of default goes way, way up. So when you think about credit risk, you may not want to go too far down into the into lower quality, because you do start running some serious risks. Likewise, let's talk about duration or interest rate risk. Interest rates have a bigger impact on your portfolio the longer the securities are. So for a 2-year note, look at the bottom line here. For a 2-year note that's par $1,000, if interest rates go up 2 percentage points, as you can see in the second column from the right, the value of that might drop by about $40 from $1,000 to $960. You can live with that. It's not huge, but you can live with it. On the other hand, let's look at the other extreme. If interest rates go up 2 percentage points from roughly 3.5% today to 5.5%, that's not a huge impact. And in fact, all of us have seen 5.5% 30-year bonds in our lifetimes. It's not that unusual. But if that were to happen, then your $1,000 bond would drop in value to about $710. In other words, you're going to lose almost 30% of the value. So duration risk can be a stupid bond trick. There are still opportunities in the bond market. Shorter-term bonds, particularly higher-yielding bonds, will have less risk as they get closer to maturity. And when you think about a high-yield bond, think of it this way. If the economy is improving, as we think it is, then a rising tide will lift all boats. That certainly is a good thing for high yield, because it means that the lower credit companies will, generally speaking, have less default risk in a rising economy than in a falling economy. So you might want to own some. But of course, in the same way that a boat can get its anchor chain caught under an undersea rock, that boat will sink when the tide goes up. In the same way, some companies still will fail even if the economy is doing pretty well. So we want to own funds of high yield as opposed to individual high yield companies. There are other ways that you can also protect yourself against rising interest rates, as I'm showing you here. Moving on to the stock market. Yes, the stock market is at pretty much all-time high prices. But let's think about this. When you buy a stock, what are you really buying? You're buying the earnings and dividends of the companies that are in an index or of an individual company if you're buying an individual stock. So let's look at the quality of what you're buying. On the green line here, I'm showing you what the cash flows, or EBITDA, that's earnings before interest, taxes, and depreciation and amortization. I'm showing you what the EBITDA multiple of interest is. That's simply a way of measuring, does this company have enough cash flow to cover its debt payments? And you can see that going back over the last 20 or so years, cash flow coverage of interest is at record highs. And at the same time, the debt to capital, which is the left-hand measure and the red line, is at pretty much all-time lows. Well, what's going on there? Companies have taken advantage of low interest rates, and they have been able to renegotiate or refinance their debt, pushing out their maturities as far as they could and taking the lowest interest rates they could get. So the health of corporate America is really, really strong right now. What about value? Is $1,950 a good price for the S&P 500? That's where it is today. Well, in the same way that $100,000 may or may not be a good price for a car. It is certainly a higher price than I've ever paid for a car, and probably many other people too. But is that a good price? Well, if I paid $100,000 for that AMC Gremlin on the left, I would say, no, I didn't get a good price, right? That was just way overpriced. On the other hand, $100,000 for that Ferrari Testarossa on the right is a steal. That car may be $250,000 for all I know. So likewise, let's think about whether an all-time high price of $1,950 is a good value or an overpriced value for the stock market. And here what I'm going to show you is the level of the stock market, the price of the market, if you will, is the green line, and the measure there is the left-hand axis. And on the red line, I'm showing you what the earnings are for the stock market. And here, look at the right side to give you a sense of the earnings per share of the S&P 500 index. And so when you see, for example, look at the year 1999. We all remember that as the dot-com bubble. And what does that mean? Well, it means prices ran up way higher than the earnings did. That's what that big gap between the two lines is all about. And so when people realize that, oh, it's not different this time, the economy hasn't changed, the world hasn't changed, we're back to understanding things the same way we always did, at that point the stock market price came down hard, but it got back to where the earnings were supporting it all along. Now fast forward a few years to 2007, and you can see here that the stock market once again hit about the same level. This time the earnings of the market were much higher, so it looked like things were in balance, except, oops, the earnings took a tumble because of the credit crisis, and as a result of that, the stock market went down with it. So here we are again. Now we're at $1,950 on the S&P. The forward earnings of the companies in the S&P are probably around $120, maybe a little bit more than that. And so you ask yourself, is this a high price or a high value? Yeah, it's a high price, but the reality is that the earnings have caught up. And so it is not an expensive market, not at all. In fact, at about 16 times earnings, the stock market is pretty much right on the median or slightly higher than the median over the past century of experience. Certainly it is comfortably within what normal variation would be. So the question here is going to be, which way do the earnings go? If the earnings keep going up, as they did at the bottom of the 2001 to 2002 recession, then the stock market will follow upward. On the other hand, if the earnings are going to crash, then we've got to get out of the stock market. I think very clearly that the earnings are going to go up, partly because balance sheets are so strong, as I showed you a minute ago, and partly because the economy overall is doing well. Very briefly, what you look at on the next chart is which stocks did well. And in the first half of this year, what's been fascinating is that defensive companies that have high dividends have done well. Utilities, healthcare, energy. These are companies that have fairly high dividends, and it indicates that investors have been concerned. They're not really buying into the notion of growth yet. The exact same thing happened last year, by the way, through the first 4 months. And then as the summer rolled on last year, people started to get convinced that the economy was in fact doing better, and this chart flipped upside down to the point that the cyclical companies last year, including consumer discretion, which you see at the bottom here, did very well. We think something similar is going to happen this year as well. So when we invest in the stock market, we think very carefully about which sectors we want to own and which ones we don't want to own. As we look forward, we think that the Fed, sooner or later, is going to have to raise short-term interest rates. Why? Because the economy is doing better. They won't do it this year. They probably won't do it until well into next year. But markets are anticipatory, so they'll think ahead, and eventually you'll see short-term rates beginning to drift upward. As to longer-term interest rates, which affect the bond markets a little more directly, there's a lot of interesting tug-of-war issues going on. On the one side, when you think about what's happening in Iraq or Ukraine or other hotspots around the world, investors globally who are afraid of the implications of those rush into the safest thing they can find, and that is U.S. Treasuries. At the same time, global bond investors will look at, let's say, a 2.5% U.S. 10-year Treasury note and say, you know, that's actually a good buy. Why? Because in Switzerland or Germany, you're looking at somewhere around 1%, and in countries with lower credit quality, like Italy or Spain, you're at about 2.5% to 3%. So either you can buy U.S. Treasuries as comparable quality but better interest rate than countries like Germany, or you can buy comparable price but much better credit than places like Italy or Spain. So on the positive side, bond prices are supported by those two issues. On the negative side, we think that the Fed is going to get out of the business of buying long-term bonds. And whenever the biggest buyer walks away from the market, prices tend to go down. The Fed wants to avoid the stock market and the bond market from getting too hot, and the economy is starting to accelerate. So all of those factors suggest that bonds prices will go down. Which way will this tug of war end? Probably to the upside. That is to say, bond prices will go down and interest rates will go up. But it may take some time, and there's going to be some balancing going on there. Where do we go with that? Overall, our tactical asset allocation right now is to recognize that the U.S. economy is positive. It's improving. It is not without risk by any stretch. Stocks are much more attractively priced compared to bonds. But remember, a year and a half ago, stocks were a lot cheaper. And in fact, stocks have been up about 35% since January of last year. So that means that they're less cheap than they used to be compared with bonds. So the rest of this year could be a bit bumpy. Bonds are still very expensive, and when you think about long-term bonds, they are not risk-free returns. They are return-free risks. That is to say, there's very little likelihood that prices are going to go up a lot for long-term bonds, and they could come down. We do like high yield, as I described earlier, and we do think that a laddered portfolio, that is buying maturities in each of several years and then reinvesting only a little bit each year, is a way to protect yourself against interest rate risk. As I said earlier, we really don't like hedge funds or private equity or venture capital, which, as we see it, have too much risk and not enough return to make up for that.